Welcome to the PlanStrongerTV market update for Wednesday, July 22nd. Let's dive right into the numbers. There is your total return for 2025 on the indices that we track, and then we'll slide those over and bring in the 2026 year-to-date numbers. Again, strong showing across the board. Hey, most of them double digits. Dow's almost there. But again, year-to-date, I'll take it right now. Give me that for the year, right? These are very strong numbers. Bonds, the only one that's, the one that sticks out. And just a reminder that negative 0.27% doesn't mean that bonds that's what they're earning. That is a price adjustment or the change in the price of the bond index that we track. So those bonds might be earning 4 or 5%, whatever it is, but that's just a way of looking at the price adjustments of bonds when you hold it in your portfolio. Okay, so let's dive right in. Robert, here we go. We've had a lot of good news lately in the markets. Dare I say, Robert's almost been giddy about some of these reports that have come out. And so with these positive numbers for inflation, jobs, some of the other metrics that you track, Robert. So with that environment, of course, it's natural to ask, well, what can mess this up, right? What can disturb or throw a cold blanket on the enthusiasm?
Yeah, the numbers as David went through them for 2025, for year-to-date 2026, in the green, double digits. But dare I say, I don't like talking about it. And a lot of my cohorts are, when I mention this, they're like, "Oh, come on, what are you talking about?" But it's so important. Like, earnings have been driving these numbers, and I've said that on the last report and in previous reports as well, David. But what if earnings don't come in as strongly as anticipated? Because everybody, all the analysts have their expectations, and it's sprawled all over the news that NVIDIA earnings coming out, we expect them to grow 80% quarter over quarter. But what if those earnings come in at 65%? 65% earnings growth in a quarter or a year. I mean, we look at that number and say that's phenomenal. But if it falls short of expectations, that can have a catastrophic effect, at least on the short term, on the stock price. And now imagine 2 or 3 of the Magnificent Seven, and maybe a handful of the semiconductor or the hardware stock come in below expectation. Now, the media is having a firestorm and going with it. So earnings have been very well. Earnings have been really pushing up the stock prices. And that may continue this quarter and the following quarter, but it will come a time when earnings will disappoint. Not necessarily fall negative. We're not catastrophizing anything. But there will come a time when they will disappoint, and that's one of the major risks, is basically earnings disappointment and that impact on stock prices.
Well, and one thing I'll add to what Robert says, which is very good, is that when you talk about the expectations by the analysts and what the market is doing, in one regard, this is very positive that we're seeing the stronger earnings and that the market is going up because of that. And so another way of looking at this, and a terminology that sometimes is used in investment circles, is those good earnings are already built into the stock price. We call it baked in the cake. That price already reflects good earnings. The very good earnings that Robert's referring to was like the tech stocks. And so if you have still very good earnings, but not as good or as great as is already priced in, you can see a drop in a stock that otherwise, or an index or an area of the market, or even the broader market, because people are like, well, wait a minute, our enthusiasm and our expectations that are underlying and causing the value of the stock market to be what it is being deflated. And so, and the other thing about this, Robert, that I want to just really add to this, that is encouraging to me, is that the loftiness, if you will, of the stock prices and how the market has been doing isn't because the market is expecting an interest rate cut, which is often part of the equation, that the market's like, okay, we're going to get a rate cut and that's going to be really good. But that's not part of the equation right now. So that's still out there at some point, maybe down the road, it just doesn't look as imminent. So with that background, is there a specific area of the economy, Robert, that you see as where we have the biggest potential risk, or a particular country? Is it just the U.S.? Are there other countries specifically that are, primed or potentially, more vulnerable to a pullback based on what we're talking about?
Yeah, so talking about from the risk perspective, there are general risks that are pertinent to all economies across the globe. When I was talking about earnings, when semiconductors are hurting in the U.S., they affect semiconductor companies based in South Korea, Taiwan, China, et cetera. But one other thing is an overall risk is demand destruction, not only in terms of companies kind of pulling back on capital expenditures, investing in AI and chips and the latest chips, but also retail consumers. Here in the United States, again, we've had a strong labor market. The consumers have uncharacteristically just continue to spend, shown signs of healthy spending. But what if that gets pulled back? You're talking about a wide range globally of demand destruction, potentially. Now, country specific, let's look at China. Their GDP came out, second quarter GDP, they expected it to be between 4.5% and 5%. It came in at 4.3%, a lot lower than they expected, showing a lot of weakness in terms of domestic consumption, retail sales, and of course, China being about 30 to 35% of the emerging market index. So that's another more specific area, the European Union. Very strict environmental regulations. So not a whole lot of domestic energy production. So they import a lot of energy with what's happening in the Middle East. Not affecting the United States as much. It's affecting us, of course. I'm not saying it's not, but not nearly as much as it's affecting Europe. So back in Europe, you have weakening growth. Their GDP expected for 2026, 0.9%, less than 1%. Inflation is moving higher. The banks are tightening lending standards. So all those kind of grow a specific set of risks for the European Union, and which is probably why in our report about a month and a half ago, I said non-U.S. Developed countries have been doing great, but year to date, not so well. Those are probably some of the reasons. So when you're looking at risks, yes, you have country-specific risks or risks specific to certain parts of the world, but also global risks that affect all the global equity markets.
It's a lot, isn't it? It's a lot to take in, but this is the reality of the world we live in. Different parts of the world economies can be doing better or worse, and what may seem, you talk about China, Robert, and it's only going to have maybe a 4% GDP. We would love to have that here in the United States, but of course, we have a much larger economy than China, and our economy is very different in terms of the consumer and the spending and the investment and all of those factors. So it's all a matter of perspective. So would you say then, Robert, it is still for most investors who have an equity, a stock portion of their overall portfolio, that it still makes sense to stay diversified internationally?
Absolutely. Just kind of like with tech stocks, don't count out U.S. growth, U.S. tech. I think for an equity exposure, it's always good to have a portion of that in U.S. growth, but also emerging markets, non-U.S. developed, small and mid caps, but also not only diversification, but if you are nervous about, the lofty valuations and, wow, I might be a little too heavy equities, fixed income, bonds. Right now the yields are great. And if demand destruction happens across the board and because of that, factories start laying off workers, manufacturing starts shedding jobs, the unemployment increases, well, guess what? Of course, we don't want rates cut for this reason, but if the economy starts to sour to that extent, we're looking at rate cuts, which is a boost to equities and also to fixed income prices. CD rates won't look as good with falling rates, but as rates and yields fall, that pushes up bond prices. They're inversely proportional.
Well, and also rate cuts then have a huge impact on the housing market and people selling their homes. And then when people buy and sell homes, incredible impact, a collateral benefit on all sorts of other related furniture sales, moving companies, all the things that are attendant to somebody buying or selling a home. So, so we do have, with the interest rates still where they are, room that if necessary, and there is, as Robert said, a shock to the system for whatever reason, and as a lot of us are very aware, these shocks to the system and significant changes usually don't come straight at us. They come at us from sideways, right, Robert? Something that we're not anticipating. We could go back over the last 5 years, 10 years, 20 years, 50 years and see situations like, well, where did that come from? And that's the nature of the market and how, the world works. So any final thoughts, Robert, about hedging and for people to be, in a position that if we do see some of these things that we're cautioning you about, that, with the good news that we're still saying, hey, let's be careful, any additional hedges or thoughts for the investors?
Just knowing that what we're talking about today, why are we talking about this? It's not going to happen, or it's not happening, but it will happen. It's going to happen. It's inevitable. So be prepared for it. Look at your plan. Say, would I completely lose sleep if the markets go down 10, 20%? If you're diversified, maybe 25% into fixed income, you can say, you know what? I can sleep at night. So really now is the time to take another look at your portfolio when the stock market is doing well, and not when things do hit us from the side.
That's a great point to end on. The best time to reevaluate our portfolios is when they're doing well, not when all of a sudden things are, like, oh, whoa, what happened? The market's down 10%. Oh, I need to do something. That's not, yes, you still may want to at that point, but a better time is to say, you know what? Things are going well, but let me make sure that I'm on the right track. And so we encourage people to do that. And of course, if you're a client of ours, we're doing that. We're looking at your portfolios and we're evaluating those risks. But this is something that I think everybody could be well served by, reflecting on.
Absolutely.
Okay, so enough reflection, but we'll come back with more fresh, new ideas. A lot can happen in a week. And we'll be back to share that with you to help you continue to plan stronger.